Mohamed El-Erian is Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University, a longtime friend of the show. Were you watching earlier, Mohamed? Because it's we can continue with a previous discussion we've already had, if you don't mind. Can you tell me definitively where we are right now? Are we restrictive? Is the current level of the yield curve, is it restrictive to the U.S. economy?
If your inflation target is 2%, you're probably neutral now. If your inflation target is a more appropriate 2 plus something, and that something is much closer to 3%. So if your inflation target is near 3%, which is where it should be, we are restrictive and we risk damaging growth unnecessarily.
You had a lot of ifs there. So nobody really knows whether it matters, though, doesn't it? If we're not restrictive, and I don't know if you can tell whether we are from how strong the economy is. I would think it's tough to find places that make it look like we're restrictive. There'd be no reason to cut at all this year. And you're starting to see people say that. Where are you now? 2 cuts? Get us down to, I don't know, get us down to 5 or so with inflation somewhere between 2 and 3?
I am where I was when the market was 6 to 7 cuts, and where now some people are saying no cuts. We're going to see 2 to 3 cuts this year. That would be appropriate. If we don't get any cuts, which is increasingly what the market is worried about, then the market is correct to worry about economic growth and to worry about earnings. But we should get 2 to 3 cuts.
What do you see? I mean, it's not just us. I know maybe people say America first, but it matters what happens in Europe, and it matters what happens, I think, in China. And how's that going to play into does it play into what we should be doing here, Mohamed, or really we just focus on domestic issues?
So, of course, it plays in. Look, China's deflation, and China has a host of problems, and they can be easily tipped into what's called the dreaded middle-income trap. China's deflation will help us as we import things from there. But our reality is the reality of Europe, which is we no longer live in a world where there isn't enough demand. We live in a world where supply is no longer flexible enough. And that has to do with lots of things, and it's not going to go away. So our reality is that the supply side isn't flexible enough. Governments aren't doing enough to help the supply side. And as a result of that, Joe, the last mile, getting to 2%, is really, really difficult. And we're starting to get a sense of that from the data.
Interesting, Mohamed. And for someone who's talked about new normals, old normals, I don't know. Have you got a new McKinsey term for what the hell where we are right now? Are we back to the old normal, or it's a new normal 2.0? What are we?
I don't have a term for you, Joe. All I tend to stress is always step back and look at the broader picture, because unless you understand the secular forces, and now it is the supply side that's in control. For a long time, it was all about deficient demand. And that's why governments and central banks threw money at it, and we didn't get inflation, and it looked like we're getting a free ride. When supply is the issue, then economic management is actually much harder, and that's where we are today.
Well, that's certainly what we hear about housing all the time, and oil, I think. The other things are sort of known and static, and what we don't know is how the supply is going to change.